Hey guys, welcome back. In today's video, we're diving deep into how AMC continues to beat the short narrative, how mainstream FUD keeps getting recycled, and why the actual data surrounding the box office paints a completely different picture from what critics want you to believe. There's been another article making the rounds attempting to discourage retail investors from touching AMC stock, and the core argument isn't even built on hard data, it's built on personal preference. The author essentially says that he prefers streaming movies at home, finds it more convenient, and therefore questions the long-term viability of theaters. But here's the problem with that logic. Personal convenience does not determine macroeconomic trends. Just because one individual would rather wait a few months to stream a film does not mean millions of other consumers share that behavior pattern. When you step back and actually analyze box office performance, attendance trends, and investment activity within the exhibition industry, you see a very different story unfolding. The theatrical model is not disappearing, it is evolving. Premium formats are expanding, theater chains are upgrading experiences, studios are recommitting to theatrical-first windows because opening weekend performance still drives cultural momentum and downstream revenue. If theaters were truly in terminal decline, you would not see capital expenditure accelerating in premium screens and immersive formats. Take the recent expansion deal between AMC and Dolby Laboratories, for example. The agreement includes adding approximately 40 new Dolby Cinema auditoriums in the United States by 2027. That is not a defensive move, that is an offensive growth strategy. Dolby Cinema locations are premium, large-format experiences with enhanced visuals, sound engineering, and luxury seating. These installations are expensive. Companies do not invest heavily in premium infrastructure if they believe consumer demand is evaporating. They invest because data supports growth. They invest because occupancy rates and per-patron spending justify expansion. This is where the disconnect becomes obvious. On one side, you have opinion-based commentary claiming people don't go to theaters anymore. On the other side, you have real capital flowing into new builds, remodels, and technology upgrades. Corporations follow money. If attendance were collapsing structurally, the logical move would be contraction, not expansion. Yet we are seeing the opposite. That alone should make investors question the fear-driven headlines. Another overlooked factor is the experiential element. Streaming is convenient, yes, but convenience does not eliminate the desire for shared experiences. Blockbuster releases are events. Audiences still show up in large numbers for franchise films, cultural phenomena, and visually immersive productions that simply translate better on a massive screen with calibrated surround sound. Studios understand this. That's why theatrical release windows still anchor major productions before streaming distribution kicks in. And when you evaluate the box office recovery trajectory, the numbers reflect resilience. Year-over-year improvements, stronger summer slates, and international market contributions all reinforce the idea that theaters remain relevant. Is the industry identical to pre-pandemic dynamics? No, but evolution is not extinction. Theaters have adapted before, from television disruption decades ago to home video to digital streaming. Each time the narrative predicted collapse, each time the industry adjusted and survived. Now, let's pivot to stock price behavior, because this is where things become even more interesting. Recently, AMC experienced downward price movement despite the absence of company-specific negative news. No earnings miss, no bankruptcy risk, no major operational setback. In fact, expansion news and steady box office performance suggest stability. So why the volatility? The timing coincided with developments surrounding GameStop, which reported earnings and announced a share offering. That announcement pressured GME's stock price, which makes sense, but AMC moved in sympathy. Why? If two companies in different operational sectors move together based on unrelated catalysts, it suggests overlapping positioning in the derivatives and short-selling ecosystem. Correlation without direct causation often signals structural market mechanics at play. When heavily shorted stocks share investor demographics and hedge fund exposure, price action can mirror even when fundamentals differ. That's not retail conspiracy, that's portfolio risk management behavior at institutional levels. This matters because it reframes volatility. If price declines are not tied to deteriorating business performance, but instead reflect liquidity adjustments or hedge positioning, then the narrative that the fundamentals are collapsing loses weight. Markets run on supply and demand, yes, but supply and demand can be influenced by routing mechanisms, derivatives hedging, and liquidity fragmentation. The broader takeaway here is that narratives often get amplified precisely when momentum threatens entrenched positions. If theaters were truly irrelevant, there would be little incentive to continuously publish discouraging pieces targeting retail sentiment. The persistence of negative commentary, even as expansion deals and premium investments continue, suggests a deeper struggle over perception. And perception in markets can drive short-term movement, but long-term direction tends to follow business viability. AMC is restructuring, expanding premium formats, and capitalizing on the rebound in theatrical attendance. Studios continue delivering tentpole releases. Consumers continue attending. Revenue streams are stabilizing and evolving. So before accepting any headline at face value, it's crucial to separate opinion from measurable data. One writer's preference for streaming does not override millions of ticket purchases. One bearish take does not negate infrastructure investment worth hundreds of millions of dollars. Expansion signals confidence, capital deployment signals expectation of return, and companies that anticipate demand shrinking do not build more capacity to meet it. The first step in cutting through FUD is asking a simple question: where is the money flowing? Right now, money is flowing into premium cinema expansion, upgraded auditoriums, and theatrical first releases. That does not align with a dying industry thesis. It aligns with transformation, and transformation often gets misinterpreted by those unwilling to adapt their assumptions. As always, none of this is financial advice. The goal here is to analyze the discrepancy between narrative and observable action. When you align headlines with hard data and corporate behavior, the picture becomes much clearer.
Beyond the mainstream media narratives, beyond opinion pieces about streaming versus theaters, we're seeing a new wave of confusion-based FUD designed to chip away at retail conviction. And some of it is honestly so illogical that you almost have to step back and ask who exactly they think will believe it. One of the more bizarre claims circulating recently is the idea that if you buy AMC shares but don't actively support the company through merchandise purchases or concessions, you are somehow shorting the company. Think about the mental gymnastics required to make that argument. Buying a stock, taking a long position, is being equated to shorting simply because you're not simultaneously increasing corporate revenue through consumer purchases. That is not how markets work. Ownership of equity and consumer behavior are two entirely separate mechanisms. When you buy shares, you are acquiring ownership in the company. You are not betting against it. Shorting, by definition, involves borrowing shares and selling them with the intent to buy them back at a lower price. The two actions are opposites. There is no data supporting the claim that retail shareholders who don't buy popcorn are somehow suppressing price. It's a narrative constructed purely to create doubt and potentially slow buy pressure. And that's important because buy pressure, real, sustained demand, is what creates upward price movement. If you can make investors hesitate or question their actions, you reduce momentum. Confusion is a powerful psychological tool in markets. We've already seen more concrete tactics that impact buy pressure, particularly in how orders are routed. A significant percentage of AMC's daily trading volume has been going through off-exchange venues and dark pools. Recently, around 63% of volume was reported off-exchange, with approximately 2.2 million shares routed away from lit exchanges, compared to just over 500,000 shares executing on public markets. That imbalance matters.
If the majority of buy orders are internalized or executed in dark pools, their immediate effect on price discovery can be muted. Price discovery works best when supply and demand interact transparently, but when a large portion of trades occurs off-exchange, the visible order book may not reflect true demand. That can create situations where strong retail